Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about the $9 trillion of ticking time bomb debt that's been built up in China by the local governments. Under Chinese law, local governments are not allowed to issue bonds directly to the markets. However, in order to get around this problem and to enable local governments to raise large amounts of capital to spend on infrastructure and other projects, in the early 90s, the concept of local government funding vehicles was established. And a local government funding vehicle is basically a company that's 100% owned by the local government and is authorised to issue bonds. And over the course of the last 30 years or so, these companies have been issuing huge amounts of bonds, and the total exposure is now standing at $9 trillion, which represents around 50% of the GDP of China in 2022. And one of the reasons that this is now a major problem for China is that the local governments are not allowed to use tax revenue to service these bonds, and the only way that they can generate cash to pay them down is by selling land. And if you've been following the channel, you'll know that the property market in China is in dire straits. Over the course of the last 18 months or so, we have seen major problems in the sector. It started with the most famous property development company, Evergrande, which has over $300 billion worth of debt itself. But the problems in the sector rapidly spread to other property developers and ultimately led to a loss of confidence in the property market from Chinese individuals. And the fall in the property market has been one of the main drivers of the problems in the Chinese economy, because the property sector equated to around 25% of total GDP. So in today's video, we'll have a look at local government financing vehicles in a bit more detail. We'll have a look at how much debt they've got outstanding at the moment. We'll look at what's been going on with regards to the cost of that debt and the issuance of new bonds and the level of bond repayments that are coming up over the course of the next 12 months. We'll look at what's happening with regards to the risk profile. And then finally today, I'll wrap up with my summary. So what I think is likely to happen over the course of the next 3 to 6 months with regards to the outstanding debt from all of the local government financing vehicles, and what the implications of this will be for both the Chinese economy and the global economy. In 1994, China consolidated the provision of tax revenue collection and sharing in order to redistribute tax revenues to less developed areas, while at the same time mandating increased local expenditure on infrastructure projects. At that time, local Chinese governments were prevented from issuing debt directly to fund capital projects. And in order to get around this problem, China developed a unique funding source for local governments to obtain the capital necessary to fund large-scale infrastructure investments. All of the provinces of China created companies called local government financing vehicles, and these companies were designed to access the capital markets by issuing bonds. Now, over the course of the last 30 years or so, issuance of these bonds has been the main source of funding for local governments in China, and the total amount of outstanding debt stands today at around $9 trillion, which, as I mentioned at the start of the video, equates to around 50% of China's total GDP in 2022. And the main problem that local governments are now facing in China is that they are not allowed to use any of their tax revenues to fund either the interest payments or the repayment of these bonds. The only source of revenue that they can use is the sale of land. Now, before we go on any further today, I want to talk to you about today's sponsor, Atlas VPN, and to let you know about their amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. If you use the internet without any form of protection, you leave yourself exposed to tracking, hacking, and advertising. Using Atlas VPN protects you from all of these. Atlas VPN provides you with comprehensive security and is used by more than 6 million people worldwide. So it's fantastic news that it will protect you from hacking and tracking and data breaches. But what's also great news is that it can save you money and open up a whole new world of entertainment, because it allows you to change your location, which gives you the opportunity to get better deals and to access content that may not be available in your region. Atlas VPN is available to use on unlimited devices for one subscription, and Atlas VPN is currently offering an amazing 3-year deal whereby you can get full coverage for only $1.83 per month, including an additional 3 months extra and a no-risk 30-day money-back guarantee. So to purchase this exclusive Joe Blogs offer, please click in the description below. This bar chart shows the year-on-year change in land sales for the 31 local governments in China. And if you look over to the left-hand side, you can see that we've got a scale ranging from minus 100%, which would indicate a 100% fall in the land sales, up to a positive figure of 60%, which would represent a 60% increase. And the line around 2/3 of the way up this chart is the 0 point. So that would indicate that land sales remained exactly the same. So what this chart shows is that out of the 31 provinces, only one of them, which was Henan, saw a year-on-year increase in land sales. All of the other 30 provinces saw a fall in land sales, ranging from 10% at the lower end of the spectrum through to around a fall of 75% at the higher end. And the way that these land sales operate in China is that everything is done through an auction system. So every month, the local governments will sell parcels of land at auction. Back in the heyday of the property development cycle 5 or 10 years ago, these land auctions were extremely popular, and developers were prepared to pay high prices because the demand for property was huge and they knew that they would be able to make enormous profits. But over the course of the last 18 months or so, things have reversed completely. Many of the developers have lost access to the debt facilities that they were using to buy all of this land because the government brought in the 3 red lines, which tried to restrict the amount of debt that property developers were taking on. And as a result of that, that led to a huge fall in demand at these auctions. And that's why we've got a year-on-year fall in sales in virtually every single one of the provinces. And as the local governments have been using this source of revenue to fund all of their bond coupons, this is now a major problem. This chart shows the bond maturity profile for the local government financing vehicles over the course of the next 5 years. And the way that this chart works, the purple section, which is the vast majority of all of these bar charts, represents bonds that have been issued within China, so are held by Chinese funds, institutions and individuals. And the yellow section at the top represents bonds that have been issued internationally. The maturity dates of the bonds issued by the local governments in China range from 2 years up to 20 years, and this chart shows which of those are due for repayment over the course of the next 5 years. All of the figures on this chart are shown in Chinese yuan, and the exchange rate to the US dollar is around about 6.9 to $1. So what this chart shows is that over the last 3 years, there's been an increase in the number of maturities that have been coming up each year. In 2021, equated to around $518 billion. In 2022 is around $666 billion. And in 2023, the Chinese local governments have total debt that is maturing of around $822 billion. So in comparison to the $9 trillion of total debt that's in issuance, the maturities in 2023 equate to around 9%. Now, in the normal course of events for any bond issuer, when your bond is coming up for maturity, what you really want to do is just renew it. You want to repay the old bond by drawing down on a new bond. That's basically how bonds work. It's essentially a perpetual form of finance. And that arrangement works fine as long as your credit risk remains the same, the bond markets are still available, and the price of your new bonds are going to be similar to what the price of your old bonds were. However, the problems that the local governments are facing in China right now are that the property market has tanked, so therefore the risk in terms of all of the future sales of land is now much higher. The amount of land that they're selling has fallen, so their income is going down, so that means that the credit risk, the chance of them defaulting on their bond, is going up. And all of that means that the price of any new bonds is going to be considerably higher than the price of the old bonds. And the reason that concerns are now rising with regards to the $9 trillion of debt is that in Q4 2022, the amount of new bonds being issued fell below the amount of bonds that are actually maturing. This chart shows the net issuance of bonds for local government financing vehicles in 2021 and 2022. 21 is shown in red and 22 is shown in blue. And what this table shows is that there's been a dramatic fall in the net issuance in 2022. In 2021, around 2.5 trillion Chinese yuan of bonds were issued on a net basis. However, in 22, that figure fell to around 1.2 trillion. So that represents a fall of around 50%. And alongside the fall in the total value of new bonds being issued, it's also been reported that the new bonds being issued are being issued for a much shorter term because the bondholders are now worried about the long-term risks for the property market in China. And this chart shows a detailed breakdown by province of the net issuance of bonds in 2022. And what this shows is that out of the 31 provinces, 17 of them issued more bonds than they repaid in 2022. The position for 6 of them remained flat, so they issued the same number of bonds as they repaid. And 8 of the provinces actually issued less bonds than they repaid. And that was predominantly because they were unable to raise those new bonds. They were struggling to be able to place new bonds. And I think what's interesting about this chart is what's shown in the red dots, because that compares the year-on-year value. So it looks at the value of the new bonds that were issued in 2022. And what this shows is that for the vast majority of provinces, 29 of the 31, the value of the new bonds that they issued was significantly greater than the value of the bonds that they repaid. So even the provinces that were issuing less bonds, they actually raised more money because the value of those bonds was greater. And the reason that that's important is that that indicates that we are looking at a bailout here. When the new bonds were issued, they were much greater in value in order to give these local authorities money. So even though the credit risk is rising and the demand is falling in terms of the number of bonds, the total amount raised was still more. And that indicates that the Chinese government is encouraging bailouts for all of these local authorities. And this chart shows the net offshore issuance of bonds in 2022 by region. And what you can see here is that there were a very small number of provinces that issued more bonds in 2022. The vast majority of the provinces remained static, so they didn't issue any new bonds. And there were a couple that actually repaid their bonds. But the more interesting part about this chart is where the red dots are lying, because that looks at the year-on-year change in value. And you can see that virtually all of these red dots are sitting at either the 0 point or below zero. So there was effectively no real activity in the international bond market for these local government financing vehicles. And the reason for that is obviously the fact that the credit risk has risen dramatically. The chances of being repaid in full on a commercial basis is now falling because the amount of land being sold each month is falling and the value of that land is also falling. So these local government financing vehicles simply don't have the cash to be able to pay the coupon or the repayment on those bonds. So the international bond market is really not interested in helping out going forward. And this is going to be China's problem. This chart looks at the risk profile of the 31 different local government financing vehicles in China. The scale on the left-hand side looks at the percentage of bonds maturing in 2023, so over the course of the next 12 months, and ranges from 0% at the bottom to 60% at the top. And the reason that we're looking at that as a metric is that 2023 is going to be a very difficult year for all of these LGFVs to be able to repay their bonds because there's been a huge fall in the value of the land sales. And so a higher percentage of bonds that are maturing over the next 12 months raises the risk of default. And then across the bottom axis, you can see the credit spread. So this is basically what the LGFVs are having to pay as the coupon on their bonds. And this scale runs from 0 to 12.5%. And what this chart shows is that the two provinces with the lowest credit spread are Shanghai and Beijing, both of which are paying around 1% as the credit spread on their bonds. However, 10 of the provinces have credit spreads above 5%. And there is actually one province that is paying above 10% as its coupon. And in terms of the percentage of bonds maturing over the next 12 months, we've got 7 provinces where more than 30% of their bonds are due for maturity. And in one province, more than 50% of all of their bonds are due for repayment this year. And the reason I wanted to show this chart is that you can see there are now a number of provinces which have a combination of high credit spreads and a high percentage of bonds maturing this year. And these are the provinces that are now running the risk of defaulting on their bonds. So what's the summary and conclusion today? Well, I wanted to share this video with you because I think what's going on in the local government debt markets in China is really a big concern for everybody. Because over the course of the last 30 years, China has developed a really interesting financing model. It's basically been funding its local government infrastructure spend by selling land in the local markets. And the way that it's been able to borrow against that is by issuing bonds. So we've got this really peculiar system whereby the local authorities are officially not allowed to borrow by way of bond issuance. However, they can create companies which are allowed to borrow. So basically, it's exactly the same thing as the local government borrowing, but clearly you couldn't make a local government bankrupt. You couldn't take legal action against them and try to enforce on any of the assets because that would be effectively going against the Chinese state. So a way around that is by setting up these companies. And all of the Chinese banks have been happily issuing bonds, and those bonds are held by Chinese funds and also Chinese individuals, because you're effectively lending to the local governments. However, the biggest problem behind this system is that it relies upon never-ending demand for land and constantly increasing prices. And of course, what we've seen over the course of the last 18 months is that the property market in China has crashed. The property developers no longer have access to the huge amounts of capital that they were borrowing from the banks in order to pay for all of this land. And over and above that, we've also seen a drop in consumer confidence, because a lot of people who'd paid in advance for their apartments were not provided with them because companies like Evergrande failed to actually construct those apartments, and so the whole market is in a complete mess now. And that's leaving all of these local governments and their local government financing vehicles very exposed, because they needed that constant never-ending demand for property to keep fueling their spending and to enable them to pay the interest on their bonds, and also to be able to replace those bonds with new bonds. So what we've got now is a structure whereby the local governments have built up over $9 trillion worth of debt. This is an enormous amount of debt. It represents around 50% of China's total GDP, and the fundamentals that were supporting the repayment of all of that debt have now cratered. So if this was a normal market, we would be facing the certainty of a huge number of these bonds defaulting, because the local governments aren't allowed to use any of their tax revenue to repay these bonds. The only way they can repay them is through the future sale of land, and because that demand for land has fallen, it's impossible for them to be able to keep up these repayments. So does that mean that we're now going to see all of these local government financing vehicles defaulting on their Chinese bond obligations? Well, the answer to that is probably not, because it's really not in the interest of the Chinese authorities to let these bonds default, because that would lead to a loss of confidence from all of the bond holders, and those bond holders ultimately are the large financial institutions and people in China. And the Chinese authorities are already trying to deal with the loss of confidence in the property sector. They're trying to build that back up, to try to get real estate back on its feet. So the last thing that they can afford right now is for everybody to lose confidence in the local governments and the bonds that those local governments have issued. So the realistic outcome here is that we are going to see a bailout of all of these local government financing vehicles by the Chinese authorities. It's highly likely that they will encourage the bond markets to simply replace the existing bonds with new bonds, and we're seeing it already. We're seeing much longer dated bonds being issued, up to 20 years, and some of those bonds don't have any repayments or any coupon payments in the first 10 years, and they also have much lower coupons. Now, in a capitalist society, nobody would buy that. Nobody would want those bonds because they're toxic. You're buying bonds from institutions that you know are bankrupt, that don't have enough money to ever repay them. So in a capitalist society, those bonds would be unplaceable. You simply wouldn't be able to find anybody to buy them. That's exactly what we saw recently when Silicon Valley Bank failed. It tried to raise more equity, but because everyone was concerned about the creditworthiness and the viability of the bank, there were no takers to buy that equity, and that subsequently led to the bank's collapse. That will not happen in China. The government will not allow that to happen. The bonds that are in issuance will be replaced, and those bonds will be replaced by financial instruments that have favourable terms that allow the local governments to get through the next few years and basically just kick the can further down the road. But the key question here really is, how can the Chinese authorities afford to keep bailing out all of the industries in China? If this keeps happening and we constantly see large companies like Evergrande and all of these local governments failing to be able to meet all of their debt requirements, at some point somebody is going to have to sort out this mess. So I guess the overall summary of today's video is that the $9 trillion of debt that the local governments have built up in China does represent a major problem. It probably will be ironed out over the course of the next 12 months or so through the issuance of replacement bonds. But at some point in the future, China will have to pay the piper. So hopefully you've enjoyed today's video, you found it interesting, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.